Hello, and thank you for joining our webinar. Today, we're going to be discussing the Medicare Part D changes and the impact that it may have on credible group coverage. My name is Nicole Kennedy, Director of Operations at HTA. Today, we will be reviewing the changes to the upcoming Medicare prescription drug plans and the impact that it could have on credible group health insurance coverage. Before we get into that, let's first go over what is Medicare Part D. Medicare Part D is the prescription drug coverage program under Original Medicare. Plans are offered through private insurance companies for a monthly premium. The average monthly premium in 2025 will be $36.78 per month. However, higher income earners pay an additional surcharge, and that surcharge can vary anywhere between $13 to $81 per month, depending on your income. That income surcharge is an additional payment on top of the Medicare Part D plan premium. Lastly, a late enrollment penalty can apply if you delay enrollment without having other credible drug coverage. President Biden signed into law the Inflation Reduction Act. The Inflation Reduction Act implemented changes to the prescription drug plan over a series of years. Previously, the Inflation Reduction Act has implemented things like having all adult vaccinations that are recommended by the CDC covered by prescription drug plans at 100%. It put a cap on injectable insulins at $35 per month for a 1-month supply. It also implemented a 0% coinsurance for Medicare beneficiaries once they hit the catastrophic coverage phase of their plan. In 2025, the biggest changes are being implemented. The one that is potentially impacting the credible coverage status of employer group health plans is that all prescription drug plans will now have an out-of-pocket maximum of $2,000. This means that Medicare beneficiaries will pay no more than $2,000 in a given year for their prescription medications. Other things that will be a part of the 2025 changes is a benefit redesign and a Medicare prescription payment plan that allows Medicare beneficiaries to pay for the cost of their prescriptions over a series of time rather than upfront at the pharmacy counter. But again, the biggie that is potentially impacting employer plans is the $2,000 maximum out of pocket. Employers are required to notify you every year whether or not their prescription drug plan is considered to be credible coverage. Credible coverage means that the plan is expected to pay at least as much as the Medicare standard prescription drug coverage. With the changes to the 2025 Medicare prescription drug plans and the $2,000 maximum out-of-pocket implementation, it now impacts the Part D determination that employers use to figure out whether or not their plan is considered credible coverage compared to Medicare. As a result of these changes, we are expecting that we may see some employer plans that have previously been considered credible become non-credible in the new year. Some of the plans that may specifically be impacted by this are high deductible health plans. However, the point of this webinar is to go over what options you will have if your current employer group health plan becomes non-creditable and advise you on the services that HTA has available to guide you through that process should it occur. Today, we are going to discuss 4 potential options that you will have in the event that your current employer group health plan becomes non-creditable in the new year. Option 1 is going to be enroll in another plan that is offered by your employer that is considered credible during your employer's open enrollment period. Option 2 will be to keep your current group health plan that is now non-creditable and enroll in a standalone Medicare prescription drug plan to continue with credible coverage outside of your employer plan. Option 3, keep your group health plan and do not enroll in a Medicare prescription drug plan. Option 4, evaluate fully enrolling into Medicare. We're going to go over each of these options specifically to weigh the pros and cons. The first and probably the easiest option to consider in the event that your current group health plan becomes non-creditable is to explore and evaluate the other health insurance plans that your employer offers. Most employers offer multiple plans, so you'll have the opportunity to switch to another plan that is still creditable during your employer's open enrollment period. Another option is that if you have a spouse or partner who is also working and have access to health insurance through their employer, you can evaluate enrolling in their employer group health plan during their employer's open enrollment period. It is our understanding that in the event that your plan becomes non-creditable, that non-creditable coverage status is effective at your plan renewal. What that means is that if your plan renews May 1st, you will continue to have credible coverage until the next upcoming plan renewal. That means that you're not in an immediate time crunch to switch or make this decision come January 1st necessarily. It's up to when your employer open enrollment period is and when the new health insurance takes place. The second option you have in the event that your current group health plan becomes non-creditable is to continue with that new employer plan and enroll in a separate prescription drug plan through Medicare. Now, this one's a little bit more complicated. There's some additional factors that need to be considered before making this decision. In order to enroll in a prescription drug plan with Medicare, you have to be enrolled in Medicare Part A. If you have a health savings account that you are actively making contributions to, enrollment into Medicare Part A will prohibit you from being able to continue to make contributions into that account. The second factor to consider is that in addition to the cost of your employer group health plan, you will now also have to pay a monthly premium to have that Medicare prescription drug plan. As we discussed earlier, the average Part D plan for 2025 has a monthly cost of approximately $37. Lastly, if you are considered a higher income earner, you may also be subject to paying an income surcharge, which can range between an additional $13 to $81 a month on top of the approximately $37 a month Part D premium. In a second here, we'll go over what those income brackets are to determine whether or not you would be subject to that income surcharge. Our third option is to keep your current group health plan and do not enroll in a prescription drug plan through Medicare. Now, the biggest factor with this option is not enrolling in a Medicare drug plan and maintaining non-creditable group health insurance will subject you to a late enrollment penalty when you do need to enroll in a Medicare prescription drug plan later on, like when you approach or get ready for retirement. We're going to go over what that late enrollment penalty is, how to calculate it in a couple of slides. Another factor to consider is that you will have only a certain window during the year to sign up for a prescription drug plan when you do need to sign up for one, and that will be during the annual enrollment period. Now, the pros to this, you still will have drug coverage. So even though your plan is considered non-creditable, if you need to fill a prescription, you do still have prescription drug coverage on your employer plan. Additionally, if you have a high deductible health plan, Because you're not enrolling in a prescription drug plan or Medicare Part A, you'll still be allowed to make those HSA contributions if you are doing so. Lastly, you won't have that extra premium of paying for a Medicare Part D plan or the income surcharge if that's applicable to you. The last option to consider in the event that your current group health plan becomes non-creditable is to evaluate fully enrolling into Medicare and actually coming off of that employer group health plan. Factors to consider when evaluating this option: do you have dependents on your plan that rely on you for insurance, meaning they would not have access to health insurance if it weren't for your employer group health plan? If you have someone who does not have access to other insurance, this option likely would not make sense for you. The second thing would be to do a cost benefit analysis, comparing your employer plan to fully coming onto Medicare, meaning what is the monthly premium I pay for my employer plan? What do my benefits look like as far as a deductible, copays, and out of pocket maximum? And comparing that to the insurance coverage you would have with Medicare, signing up for both Medicare Part A and Part B, exploring secondary insurance, and of course, the Medicare prescription drug plan. This is an analysis that an HTA Medicare advisor would be happy to assist you with. The third thing to consider is, when is your anticipated retirement date? If you're thinking of retiring in the near future, it just might be easier to rip the Band-Aid now, make that transition off of the employer group health plan, and enroll fully into Medicare with that Medicare A and B and secondary coverage, plus the prescription drug plan. That way you continue with the credible coverage and you don't have to worry about it when your retirement date comes. Let's spend some time comparing option 2 and option 3. And I call this to enroll or not to enroll. This is going to be most people's dilemmas in trying to determine whether or not signing up for a separate prescription drug plan makes financial sense given their particular situation. In order to do this, we need to assess the cost of enrolling now in a Medicare prescription drug plan, paying the monthly premium for that plan, and the potential income surcharge if it applies, versus deferring a Medicare prescription drug plan and paying for a late enrollment penalty later on. In order to make this determination, let's first spend some time on the income surcharge as well as the late enrollment penalty for Medicare Part D. Let's start with the Medicare income surcharge. Individuals who make over the base income tier will pay an income surcharge on both their Medicare Part B as in boy and their Medicare Part D as in drug plans. The incomes are based on your tax return from 2 years prior. So it depends on how you file your taxes first, whether you file them on a single or a joint basis. And again, they're looking at a tax return from 2 years ago. So in 2025, they'll be using your 2023 income to determine what that surcharge amount would be if it applies. The base income tier, the first level income bracket, is not subject to an income surcharge, meaning they do not pay anything extra to have Medicare prescription drug coverage. All they have to pay is the monthly premium for their specific prescription drug plan. If you fall higher than the base income tier, on top of the prescription drug plan premium from the insurance company, you will pay an additional income surcharge, which can range anywhere between approximately $13 a month all the way up to $81 a month, depending on which income bracket you fall in. Now let's talk about the Part D late enrollment penalty, what it is, and how it's calculated. To calculate the late enrollment penalty, you're going to take 1% of the national base beneficiary premium. Next year, in 2025, that national base beneficiary premium is $36.78. And then multiply that by the number of months that you were eligible for Medicare and went without having credible prescription drug coverage. The total will be a monthly penalty that is added on top of the monthly premium that you pay to the insurance company to have the prescription drug coverage. And unfortunately, it is a lifelong penalty that stays with you forever as long as you have Medicare prescription drug coverage. You can see in the chart below an example of what the penalty amount would be depending on the length of time that you went without credible drug coverage. So, for example, if someone went 1 month without having credible drug coverage, they would have a 36-cent per month penalty. If someone went 12 months, a full year without having credible drug coverage, they would have a $4.41 per month penalty. 2 years, $8.82, and 5 years, $22.06 per month. Now, this is the penalty for 2025. Now, the base beneficiary premium can and typically does increase on an annual basis, so that's just something to keep in mind. Now that we have a better understanding of the income surcharge as well as the late enrollment penalty, let's apply a potential real life situation to help determine whether or not someone should enroll in Medicare Part D should their drug coverage with their employer become non-creditable. In this example, we have an individual who files their taxes on a single basis. Their income in 2023 was $140,000, and they're anticipating retirement in the next 2 years. In example 1, they are continuing with their employer group health plan, which has now become non-creditable for prescriptions, and have decided to enroll in a separate prescription drug plan with Medicare to continue with their credible coverage status. Now, on top of the costs that they pay to their employer for their employer group health plan, they are going to also have a prescription drug plan premium, approximately $37 per month. The income of $140,000 puts them in the third income bracket, which gives them a surcharge of $33.30 per month that they have to pay on top of the Part D premium. So total cost to enroll in a prescription drug plan for this individual is approximately $70.30 per month, or $843 a year. Now, in this situation, we're anticipating this individual to retire in 2 years. So assuming they have this prescription drug plan program for 2 years, their total cost of having this Part D plan will be approximately $1,686. Now, this is just the premium for the plan. These costs do not take into consideration prescription drug costs. Taking the same individual, let's go through the scenario if they were to waive Medicare Part D, meaning they get the notice that their employer plan is no longer creditable, they keep their employer drug plan, and they decide not to enroll in a standalone drug plan through Medicare. The factor to consider with this situation is that when they do need to sign up for Medicare in the future, like when they anticipate retiring in 2 years, they will be subject to a late enrollment penalty. In this example, this individual went a full 2 years without having creditable coverage. So taking the base beneficiary premium of $36.78, multiplying that by 24 months would yield a Part D late enrollment penalty of approximately $8.82. To determine the break even between option 1 of enrolling and option 2 of waiving, we need to calculate how many years of paying a Part D penalty is it going to take to surpass the total cost we would have spent should we have enrolled in a Medicare drug plan while we were still working. In this example, the total cost of enrolling in a drug plan for those 2 years costed this individual $1,686, divided by that monthly penalty of $8.82, yields a total of $191. That means it's going to take 191 months of paying that Part D penalty of $8.82 before your out of pocket exceeds the cost of what it would have spent to enroll in the drug plan in the first place. It's all a little confusing, but basically, it would take you 16 years of paying the prescription drug plan penalty to equal the cost that you would pay to have a drug plan for those 2 years while you were working. Now, this is just one example. There are going to be a lot of little factors that play a role in making this decision. Whether or not you're in the base income tier or the highest income tier is going to play a huge part in figuring this out. How long until retirement is another key component, because the length of time you go without a drug coverage is going to increase that penalty amount. The good news is you don't have to make this decision alone. HTA's Medicare advisors are here and available to help you weigh the pros and cons of your particular situation so that you can make the decision that makes the most sense for you. Displaying on the screen in front of you is a QR code that you can go ahead and scan with your smartphone device. It will bring you to our website, which will prompt you and give you the ability to schedule a consultation with one of our Medicare advisors on either Zoom or over the phone. I want to thank you for joining me for today's video. Please go ahead and contact us. Our phone number and email are also displayed on the screen with any questions that you may have as a follow-up to this video. Thanks so much and have a great day.